that a company is simply an association of persons. These persons, basically, they are coming together so as to be able to provide goods or services to consumers with actually an aim of making a profit, Then we said under this particular subject, basically, we are going to look at the rules and regulations governing operations of companies. And basically here, under company law in CPA, we are interested in operations of companies in Kenya and the law regulating that particular, those particular operations. We said it is actually the Companies Act of 2015. It is the Companies Act of 2015. So this will basically be our key focus in terms of the law that regulates operations of companies in Kenya. So we looked at the characteristics of a company. So we said what should actually come to your mind first, that a company is actually a form of business. So amongst others, we can have sole proprietorships, we can have, for example, partnerships, or we can have cooperative societies. So we said the key characteristics of a company include, for example, in this case, the key one, the most dominant one, is said a company is actually a separate legal entity. It is actually a person on its own from the owners, or maybe a person on its own from the persons who actually formed that particular company. Then we said it is an artificial person. Since you are saying it is a person, it is actually a man-made person. Why is it a man-made person or an artificial person? It comes into existence after it has been created by a natural person like me and you. So that particular process of actually coming up with the company, we learn about it later on in a topic known as formation or promotion of companies. We said it has the capability or the capacity to be able to contract. It can be able to enter into contracts with the other corporate companies or corporate entities, or basically enter into contracts even with individuals in terms of, let's say, for example, engaging employees. So it has that particular capability or capacity of actually being able to contract with other parties. You also said it can be able to sue or be sued in its own name. It has the capacity to be able to own property in its own name, or property being acquired and being registered in the name of the company. We said it has what we call perpetual succession, or it can exist into perpetuity. So its existence, since we are saying it doesn't depend on the life of the owners or the founders, we say the company can actually exist into perpetuity, or can actually exist for a very long period of time. We said it can have what we call a limited liability. We try to explain what is actually a limited liability. That in a company, there can be a situation, depending on the type of the company, whereby your liabilities of you as the owner or as a shareholder or a member of that company will have a limit. They'll only be able to go up to a particular extent. And of course, that particular extent can actually be defined either as in terms of the number of shares you have in the company, or maybe as to what guarantee you've given, you can be able to contribute towards the assets in case the company is actually liquidated. So those were some of the characteristics that we actually looked at. And of course, we looked at the types of companies. We say the classifications basically are with regard to companies under the Companies Act. We say there are basically 5 key categorizations in this case. So you can have a limited company, we can have unlimited company, we can have unlimited company, and we can have a private company or a public company. But for a limited company, we said that it can actually basically be split into 2, whereby we said it can be limited either by shares, or actually it can be limited by guarantee. So we actually try to explain what we mean by a company limited by shares, and what we mean by a company limited by guarantee and a company limited by shares. So we said we can have unlimited, exactly now the opposite of this one. Then we can have a public, or we can have finally a private company. So these are the classifications under the Companies Act of 2015 as to how you can be able to categorize companies. But we say there are other classifications, and I think that is basically where we were now looking at. So we had actually started with the other classifications of companies. Apart from those classifications of companies under the Companies Act, how else can you actually be able to classify companies? How else can you actually be able to classify companies? So we are looking at other classifications, or how you can categorize companies, other classifications of companies. And specifically, we had actually now just looked at what we mean by a corporation sole. Corporation sole. So you just defined what is actually a corporation sole. So this is where we said that a corporation sole is actually an independent office that is normally held by a person each and every time. And of course, there is what we call succession in the office. So we gave an example. Let's say, for example, the office of the president, we have what we call succession in that particular office. We gave an example of, for example, the office of the bishop. You have succession in that particular office. And we said, if you look at how the office actually operates, then of course it can be categorized or be seen as a form of a company or a corporation, since it is actually independent from the holder. Its existence doesn't actually basically depend on the life of the holder. It doesn't mean that when the president is not actually there, the office basically will remain vacant. In case of maybe even death or something, it simply means that another person will actually be able to assume the office, and the office will basically continue to be in existence. Any properties acquired by the office or for the benefit of the office or for the purpose of the office will likely remain in the ownership of the office. So that person who's basically retiring or being succeeded doesn't go home with the assets or properties of that particular office. The office basically will remain independent, and of course, there'll be what we call succession in the office. So due to those particular characteristics, then it can actually be seen as some kind of a corporate body or basically a company. So we are just now going to look at what we mean by a corporation aggregate. Corporation aggregate. What we mean by a corporation aggregate as another classification of companies or corporations. So corporation aggregate is now actually the opposite of this one. So this one is actually held by a sole person. So what we mean by a corporation aggregate, it is any type of a company, or it is any company which is actually owned by two or more persons. So it is any company that is owned by two. It is a company whose ownership is by two or more persons. It is by two or more persons. So such kind of a company, or basically such kind of a corporate entity, will actually be known as a corporations aggregate. So anytime you actually log into the Zoom, basically you can mute yourself. You can mute yourself or mute your background so that that noise that is being made in your background doesn't actually basically interrupt the others who are actually in the class. So you can just, once you join the class, you can mute the background. If you want to ask a question, you cannot, there's a place you can raise a hand, or basically you can just chat there. There's an option to chat, or you can unmute yourself and of course ask the question. But if you are not actually asking any question, you are just listening, get used to basically muting your background so that any noise that is being made in your background, even by any person, maybe there are people in your background, they are doing other things. So they basically won't actually basically interrupt the class. So you are saying that a corporation aggregate, it is a company whose ownership is actually by two, or is actually basically owned by two or more persons. So another thing you have to note about this one is that the other characteristics of a company, should actually be in existence. The other characteristics of a company should be in existence for this to be known as a corporation aggregates. So the key characteristic that should actually come out clearly, it is that this particular company is owned by two or more persons. So once the other characteristics are actually in existence, then it can actually be categorized or classified as being a corporation aggregate, So the other characteristics of a company should actually be in existence. What I mean by this, all those other characteristics we learned about a company should be in existence for it actually basically to be concluded to be a corporation's aggregate. Then once this key characteristic is present, then it can be categorized as being a corporation aggregate, So what we mean by this Let's say, for example, we say that in a private company basically will actually be owned by 1 up to 50 persons. So it therefore basically leads to the conclusion that any private company that is actually owned by 2 or more persons can be categorized also or be classified as actually being a corporation aggregate. We said that public companies should actually have a minimum of 2 persons with actually no limits, that is actually given as to how many persons can actually be able to form a public company. So the minimum is actually 2, and there's no actually maximum limit. So it simply means that all public companies can actually basically be categorized or classified as being a corporation aggregate, because in this case, these companies are actually owned by 2 or more persons. So any private company that is actually owned by 2 or more persons can also be classified as being a corporation aggregate. Remember what I told you, these are simply classifications. It doesn't mean that when a company is a private company, then you can't classify it as a corporation aggregate. So long as there are characteristics in that particular company that can actually basically lead you to classifying it under a corporation aggregate, that particular company will be classified as being a corporation aggregate. So that is what we mean by a corporation aggregate. So sometimes in the exam, they have tested and actually asked a question, distinguish between a corporation sole and a corporation aggregate. Then of course they put there, like, let's say for example, like 4 marks. We simply basically now need to be able to understand what is a corporation sole and a corporation aggregate to be able to distinguish the two, So another classification that we can have for companies, it is what we call statutory corporations. Statutory corporations. Statutory corporations. What are statutory corporations? Statutory corporations. Statutory corporations. Statutory corporations. Statutory corporations. What are statutory corporations? So these are basically, you've heard about them. So some people call them parastatals. So you've heard people say that I really wish to work in a parastatal. So there's a lot of work. Basically, I leave work. Let's say, for example, by 3, I'm off work. I don't work on Saturday, or don't work on Sundays. I would wish to work in a parastatal. So those particular bodies that people wish to work in, they call them parastatals, are the ones we term as being statutory corporations. So what are the key characteristics about a statutory corporation? So you can just indicate like a small heading under that, characteristics. How can you be able to know it is actually a parastatal or is actually basically a statutory corporation? So number 1 key characteristic about them, they come into existence. They come into existence through an enactment of an act of parliament, So their existence basically they'll come into existence basically through a law being passed in parliament. So there'll basically be a law that will be proposed in parliament that a particular statutory corporation should actually be formed. Another key characteristic is that the Act of Parliament will set out the Act of Parliament will set out the management structure. The Act of Parliament will set out the management structure of the corporation, the management structure of the corporation. So in that particular act, I hope you know what is actually an act. An act is basically a law that is basically passed through parliament or is actually approved by the parliament, or it is made through parliament through a process known as legislation. So you've studied about or you've learned about business law, or sometimes nowadays it is actually known as Introduction to Law and Governance. So you've learned about legislation, the lawmaking process in parliament. So a proposed law in parliament is actually known as a bill. So when that particular bill has actually been approved by parliament, it is normally assented to by the president. So he basically signs it to become an act. Like you are talking about, the act that regulates operations of companies in Kenya, it is known as the Companies Act of 2015. So before it became a law, it was actually basically a bill that was basically proposed in Parliament. So it was actually basically brought before Parliament. So it was discussed, went through all the stages of legislation in Parliament, and of course, it was basically sent to the president, and eventually he signed it into law. He signed it into law, and it became the Companies Act of 2015. So a proposed law in Parliament, it is known as a bill. Once it is actually approved, basically now it actually becomes now an act of Parliament. It becomes a law that basically people should actually be able to conform to. So it simply means that these corporations we are talking about, these parastatals where you wish to work, they came into existence maybe after the government saw there was actually need for such a statutory corporation. So they proposed a law in Parliament. That law was actually basically approved by members of Parliament. It was brought before the president. He eventually assented to that particular proposed bill, and it became an act of Parliament. So that law basically clearly set out that this particular corporation should actually be formed. So why do they form them? So another key characteristic, why do they form them? Why do they form them? They provide, you can say it is formed to provide essential services. It is formed to provide essential services to the citizens. It is formed to provide essential services to the citizens. So other than that, you can elaborate the point further and say profit making is a secondary objective. It is not the main objective. It is not the primary objective. Profit making is a secondary objective. Profit making is a secondary objective. Profit making is a secondary objective to them. So that should actually basically lead to a question. What are some of the examples? You can give several examples about statutory corporations. You can talk about e.g., maybe you can put something small here in your short notes, e.g., Kenya Broadcasting Corporation, Kenya Railways Authority, Kenya Port Authority, Kenya Pipeline Corporation, Kenya Pipeline Corporation. So there are several of them. There are several of them. So they are majorly formed. They are majorly formed to provide essential services to the citizens. Profit making for them is just basically a secondary objective. Their main objective is to provide essential services. So that's why they are normally basically proposed in Parliament. Then the law is actually basically approved, and of course it becomes an act of Parliament, and eventually they actually formed. So another key thing to note about them, is that they are usually funded by the Treasury. They are usually funded by the Treasury. They are usually funded by the Treasury, or the Ministry of Finance. They are usually funded by the Treasury. In case they make any profits, they are utilized for expansion. They are utilized for expansion of services to citizens. They are utilized for expansion of services, or sometimes these profits can be remitted to the Treasury because it is the one that funds them. They are remitted to the Treasury, or Ministry of Finance. So that is basically what actually happens. In case they make any profits, those particular profits will basically be utilized for expansion of the services to the citizens. Expansion of services to the citizens. They are normally funded by the Treasury or Ministry of Finance. So another last one, key characteristic for them, they don't undergo the normal liquidation process. Their life can only come to an end. If that act of Parliament that formed them, that law that actually formed them, is actually revoked or actually superseded by another law. So long as that law is still in place, that act of Parliament is still in place, they'll basically be presumed to be still in existence. So they don't undergo the normal liquidation process that we'll learn about later on. in our study of company law as the last topic, probably the last topic, as to how companies are normally liquidated. For them, they can only be liquidated, or the life will only be seen to have come to an end when that law that actually formed them is actually revoked or cancelled, or basically it is superseded, or basically there's another creation of another law that supersedes that particular law. So they don't undergo the normal liquidation process. They do not undergo normal liquidation process. They don't undergo normal liquidation process. But their life will only come to an end, if the acts that formed them is revoked or superseded by another law. It is superseded by another law. So that is basically the only way as to how their life can actually come to an end. So that is how basically their life can come to an end. That's how basically their life can actually come to an end. So that is what we mean by a statutory corporation. So maybe in the exam they could ask, state the key characteristics of a statutory corporation. You can just mention the ones we've just gone through. So we can look at another classification of companies. And look at another classification of companies. And in this case, you can talk about holding and subsidiary companies. So what do you mean by a holding company? It is a company that has ownership or a financial stake in another company, and it is actually able to control the activities of that other company. So it will actually be known as a holding company. It has a financial stake, or it has financial ownership, or it has a shareholding in another company, a majority shareholding in another company, and therefore it is actually able to control its activities. So I think we can give some scenarios. There's this bank, I don't know, it's KCB. So KCB it actually acquired, is it Jamii Bora Bank? It acquired, I think, that Jamii Bora Bank. So it is actually known as, is it Kingdom Bank or something? So you find that KCB Bank acquired this particular bank known as Jamii Bora Bank. I think it's known as Kingdom Bank or something. There's a name that it was changed to. It's known as Kingdom Bank or something. So just like that. So it simply means that, let's say, for example, in this case, KCB acquired like 90% of ownership. What do you mean by 90% of ownership? They acquired 90% of the shares of, let's say, for example, Jamii Bora Bank. So you can see they're the majority shareholders. So it simply means that the ownership of that company, 90% of it in terms of assets and everything, is actually basically controlled by KCB. In this case, KCB actually becomes now a holding company in relation to Jamii Bora Bank. And of course, in this case, Jamii Bora Bank becomes a subsidiary. It becomes a subsidiary. So what we mean by that is that a holding company is actually a company that is actually able to control the affairs or activities of another company by the virtue of basically controlling the majority of the shares of that other company. So in this case, the other company is a subsidiary. The other company is a subsidiary. So that is what we mean by a holding and a subsidiary company. It is a company that is able to control the affairs of another company, that is able to control the affairs of another company by the virtue or basically as a result of having a majority or having acquired a majority of the shares of the other company, So the other way around, the other company is actually a subsidiary. So if I try to basically define a subsidiary, basically say it is a company whose activities are actually controlled by another company as a result of its shares having been acquired by that other company, which is actually now a holding company. So in this case, as we just try to demonstrate, KCB is actually the holding company and Jamii Bora Bank is a subsidiary. So I think maybe you'll learn about this one in financial reporting. You'll be able to be told what is a holding company, how do you prepare the books of accounts in such a scenario. So maybe those who have been to a financial reporting class will actually be able to understand what we mean by preparing the books. They are known as consolidated financial statements, consolidated financial statements. So you simply combine the accounts of the two and come up with one balance sheet and come up with one income statement. That is what we mean by a holding company and a subsidiary company, a holding company and a subsidiary company. So another classification, chartered companies, chartered companies, chartered companies. Chartered companies. So what are chartered companies? These are companies that come into existence through the issue of what we call a charter by an authorized person or by a particular authority. In this case, we can give our best example. Private universities are normally formed through an issue of a charter by the president. How those private universities operate, if you look at how they operate, they are like some form of a corporate entity or a company, because in this case, the life of the private university doesn't depend on the life of the students there. Students will come, they'll go, they leave the university, it will still be there. A vice chancellor will come, serve his term, and basically leave. Other vice chancellor will come and actually assume the office. So how it actually operates, it simply means that its existence won't actually basically depend on the people actually there. So it is actually like some form of a company or a corporate entity. And how do we define it? It is a company that comes into existence through an issue of a charter by an authorized person, an issue of a charter by an authorized person. So what you mean by a charter is the authorization, or basically that particular document that gives out the authorization for that particular company or corporate entity to basically continue to operate as maybe a private university. So examples you can give of chartered companies are private universities. So they come into existence as a result of issue of a charter by an authorized person. So in this case, in Kenya, it is actually the president. It is the president who gives out the charter. It is the president who gives out the charter. So another classification, foreign companies. Sometimes we call them companies incorporated outside Kenya. So what do you mean by a foreign company? It is a company which originally it was not actually incorporated in Kenya, but of course it has sought a base, or basically it has sought to carry out operations in Kenya. So originally, if it was registered somewhere else, and of course they want to set up operations in Kenya, they'll basically be recognized in Kenya as being foreign companies, because originally they were not actually incorporated or registered in Kenya to carry out business. But of course, they have seen there's a market in Kenya. They'll basically come here in Kenya and set up base or set up operations. So in Kenya, basically they'll be recognized as being foreign companies. So it is a company which originally it was not actually incorporated or registered in Kenya, but of course it has sought base or sought operations or to carry out operations in Kenya. It will therefore be known in Kenya as being a foreign company. Sometimes they are known as companies incorporated outside Kenya. So basically, if you look at the companies, actually, you'll see they have actually been classified or basically named as companies incorporated outside Kenya. So mostly, basically, they are usually the international companies you see carrying out operations in Kenya. So that is what we mean by foreign companies. 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 So those are some of the other classifications or how you can actually be able to classify companies, how you can be able to classify companies, how you can be able to classify companies. So I want us to look at another subtopic about this particular topic. So I want us now to distinguish between a company and the other forms of business. I want us to distinguish a company because we've already said initially a company is a form of business. So how do you distinguish it from the other forms of business? So distinction between a company and other forms of business of business. In this case, we mean a sole proprietorship, partnership, and cooperative society. 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 Distinction between a company and the other forms of business. And the other forms of business. So that in that case, we mean a sole proprietor partnership and a cooperative society. And a cooperative society. So in this case, for you to be able to distinguish, then what you just need to be able to know, first of all, what are the characteristics of these other forms of business? So if you know them, basically you can be able to distinguish because we've already seen the characteristics of a company. So you need to be able to understand what are the characteristics of a sole proprietor. Then you simply compare the two. If you compare the two, basically you'll get distinctions or actually differences. So in this case, for example, if you start with a sole proprietorship, if we start with a sole proprietorship, what is a sole proprietorship form of business? You need to basically be able to list down, let's say, for example, several characteristics for you to be able to distinguish with a company. So what are the characteristics? Number one, what you need to be able to know about this particular form of business. Number one, it is formed by a sole person. It is formed by a sole person. I think this is what you learned about in business studies. If you've done business studies or entrepreneurship somewhere else, you must have come across this particular characteristics we are just looking at. It is formed by a sole person. So that is number one characteristic you've been able to mention. Number two, few legal formalities on formation. This one you must have heard about it. Few legal formalities on formation. Few legal formalities on formation. Few legal formalities on formation. You must have heard about another one. Enjoys profits alone. Enjoys profits alone. The sole owner enjoys profits alone. Sole owner enjoys profits alone. And there's now the other side, suffers losses alone and suffers losses alone and suffers losses alone and suffers losses alone and suffers losses alone. So another thing you must have heard about it is that this particular form of business is that it is easy to keep business secrets. It is easy to keep business secrets because you are the sole owner of the business. There is no any other person ambaye atapeleka mshene about your business. So in this case, if you're operating that particular Kamtumba business of yours, people might be thinking maybe you are making a lot of money out of it. But of course, you are the only one who knows how much you are able to make in a day. So then they are just spreading rumors that you are making a lot of money. Yet, you know, you are the only one who knows where the shoe is pinching, because in this case, you are the sole owner. You don't basically have ownership or basically discuss with any other person. You're the one who basically carries out the business as a sole owner. So it is easy to keep business secrets. It is easy to keep business secrets. Business secrets. It is easy to keep business secrets. Another thing about a sole proprietorship form of business that you know about it, but maybe you can't mention it now, or maybe you have forgotten, easy decision making. It is easy to make decisions in a sole proprietorship form of business. Easy decision making. Easy decision making. Easy decision making. It is easy to make decisions in a sole proprietorship form of business because when unajiita tu mkutano, unaweza hata amka siku moja useme nataka kulala, sitaki kwenda kuuza. Jana nilifunga ya wiki yote. I sold for the whole week. I made money for the whole week, so I don't need to go to the market today. So basically, I can just sleep today, then I wait for next week, or I strategize for next week. So you basically decide as to how you'll be able to run your business by your own. You don't discuss with anyone. There's no any form of argument with any other person. You argue with your brain and, of course, make the decision by yourself. So you don't discuss with anyone. So it becomes very easy to make decisions. So you don't discuss with anyone else. Another thing is that what you need to be able to note about this particular form of business is that, for example, if you look at that particular kiosk that is actually operating just outside your door or at your neighborhood, whereby, for example, if you haven't been able to make it to the supermarket, that's basically where you go to get maybe your salt. You didn't know that the salt is actually almost over. So you run there very quickly and get your salt. Or maybe you find that you've woken up, maybe it was actually the weekend, you are actually very tired, you can't actually be able to make it to go and get milk from the supermarket. You decide, let me go to the next shop, What you'll be able to realize about this particular shop and the shopkeeper, this shopkeeper is actually able to note all the customers that will actually come to the shop. So most of the time you find that those kiosks, if you've actually been to maybe hapo mtaani, umekuwa hapo mtaani, unapata kwamba kuna wale hata anakopesha tu, anawaambia you'll pay me at the end of the month. So anaandika majina yao chini, anawakopesha. So he's actually basically to be able to understand and actually know almost all his or her customers. So what I mean by this, there's usually what we call personal customer touch in a sole proprietorship form of business. You're able to interact with the customers one-on-one. You are actually able to understand them. Unajua huyu huwa analipa, huyu siwezi muuzia, huyu siwezi mkopesha, huyu alipangi, nishai mkopesha akakosa kulipa. So there is what we call personal customer touch. So that is another characteristic about a sole proprietorship form of business. Personal customer touch. Personal customer touch. Personal customer touch. Personal customer touch. So those are some of the key characteristics about a sole proprietorship form of business. So what you need to actually also be able to note, if you try to compare with a company, there's no what we call principle of separate legal entity. There is no principle of separate legal entity in a sole proprietorship. No principle of separate legal entity. So what we mean by this, hizo madeni za hiyo biashara ni kama tu zako wewe mwenyewe. So ukikosa kulipa, watakukujia, wakunyang'anya hizo nguo zako zenye unauza, waende wauze. It doesn't actually happen in the same way in a company. There's a process. They can't just come and actually take over the assets of the company. So they'll follow a particular process before the assets are actually taken over. But for a sole proprietorship form of business, madeni za biashara ni kama tu hata zako, wanaweza kuja nyumbani kwako wakuambie ulipe. So there's no principle of separate legal entity. If basically, for example, if you acquire assets or properties, they'll be registered in your name as the owner of the business, not like in the case of a company. So these are some of the key characteristics of a sole proprietorship form of business. So what have I told you? What you just need to be able to know or have in your mind is how does a sole proprietorship form of business actually operates. And this is how it actually operates. If you know these ones, basically what you now need to be able to do to distinguish, you just, let's say, for example, take each one of them and start comparing with how a company operates. You'll get a difference. If you start just looking at them one by one and compare with the other side of a company, you'll get a difference. So that's why I'm telling you the key thing here is to know the characteristics. You don't have to basically stress yourself by knowing like each and every distinction. A company operates like this, while a sole proprietorship form of business actually operates like this. If you just actually able to list down the characteristics, you just start comparing them, you'll be able to get the differences very easily. For example, in this case, if you start with this one, it is easy to make decisions in a sole proprietorship form of business. You compare with the other side of the company. If you look at in the case of a company, for example, you've said in a private company, probably will have 1 up to 50 members. In a public company, we'll have at least 2 persons and no maximum limit. So huku kuna na a lot of arguments. Mnakuja meeting, mnaanza kugombana, hata mnapigana. Like what actually normally happens in parliament, watu wanapigana, wanapigwa macho. So here you are making the decisions alone. So you just fight, unajipiga wewe mwenyewe, unapigana tu wewe mwenyewe na mind yako na make a decision. But in this case, for a company, it is not easy to make decisions because there are several persons, kuna watu wengi. So you have to sit down. This one has his own opinion. This one has his own opinion. So by the time you make a decision, it's actually very difficult. So in this case, we mean that it is easy to make decisions in a sole proprietorship form of business, while in a company, it is actually a bit difficult because a company is actually made up, or the ownership or the shareholding is by many persons. So the decision making in a company will actually be a bit difficult. So that is already a difference you've actually been able to note. It is formed by a sole person. So a sole proprietorship form of business is actually normally formed by one person. So you just compare with the other side of the company and say, while in a company, for a private company, it can be formed by 1 up to 50 persons. If it is a public company, it can be formed by at least 2 persons with no maximum limit. That is already a difference you've actually been able to get. If you look at this one, few legal formalities. It is not the same case with a company. In a company, there are a lot of legal formalities, so basically to be fulfilled before you can actually be able to form the company. So the process forming of a company is actually a bit tedious when compared to a sole proprietorship form of business. So that is already a difference you've actually been able to get. This one, the sole owner enjoys profits alone and suffers losses alone. You compare with the other side of the company. In a company, they share the profits in form of dividends at the end of the financial year. You can see in this case, in a company, they are sharing profits. But here, hu jamaa anakula profits peke yake, anakula profits peke yake. But in this case, in a company, you know what happens in a company. The profits are normally distributed in the form of dividends at the end of the financial year. So there is actually profit sharing in a company when you compare with a sole proprietorship form of business. That is only a difference you've actually been able to get. You go to the next one. We are saying it is easy to keep business secrets because you are the only one who's running the business. It is the same case in a company. No, in a company, you are many people. So if you're, let's say, for example, if you're in a private company, you're like maybe 10 people. So huwezi jua ule mtu ata reveal secret ya kampuni ama atatembeza your secret ya kampuni because you are many people. So you can actually basically not say that you can't actually basically reveal the secrets of the business. Any person can actually be able to pass the information to other persons. Also, in the case of a public company, you know that it is a requirement, or basically you have to note or know that in a public company, it is a requirement they publish their books of accounts. Sometimes you've seen in the newspaper, certain companies have put their books of, just be keen, especially around the month of June, somewhere there, or maybe April. If you go through the newspapers, you'll see certain companies before the AGM or the annual general meeting, they have been able to put there their books of accounts, the income statement, how they performed, maybe in a quarter of the year or maybe in a full year before just the annual general meeting. So for them, they simply publish their books of accounts. So come in and make losses, utajua kwamba hii kampuni inajifanya fanyanga tu hapa with a lot of publicity, yet they are making a lot of losses. So they can't keep business secrets because it is a requirement under the Companies Act. It is a requirement under the it is under the law. Ni sheria kwamba hizi kampuni lazima publish their books of accounts in newspapers, on their website. You'll be able to get their books of accounts. So for them, if they do such, are they keeping business secrets? Remember, we've said kwa hii sole proprietorship form of business yako hii ya mtumba, kama una make losses, hii biashara ya mtumba una make losses, watu wana assume huko nje tu kwamba ati una make profits mingi. Kumbe wewe mwenyewe ndio unajua hii biashara ni ngumu, hata hakuna kitu natengeneza, najikaza tu. So you can be able to keep that particular business secret. But for them, they can't, because for public companies, their books of accounts are actually normally published. That was really a difference you've actually been able to get. So it is easy to keep business secrets in a sole business. But of course, in a company, it is not actually easy, because a company is made up of many persons. And of course, also for public companies, they are actually required under the Companies Act to be able to publish their books of accounts. You go to this other one, personal customer touch. Personal customer touch. You as the owner of the business, you're actually able to understand your customers properly, because you are the one who is actually running the business. But in the case of a company, you as a shareholder at Safaricom, are you the one running the affairs at Safaricom? For you, you just wait for the profits at the end of the financial year. But in this case, you have actually appointed directors, and actually the directors have appointed employees to run the affairs of Safaricom on behalf of you as the shareholder, as the owner. Remember, if you are a shareholder, you are the owner of the company, just like the sole owner of a sole proprietorship form of business. You as a shareholder at Safaricom, you being one of the owners, you don't basically even know the customers there. You've just actually appointed people to run the company on your behalf, the directors. So there is no personal customer touch for you. You don't even understand your customers properly. But for him, since he's the one running the business, he's actually able to understand his or her customers very properly, very properly. So this one, on this one, basically, you can get a lot of differences. The principle of separate legal entity is actually in existence in a company, because you are saying for a company, it is able to contract in its own name. It is able to sue or be sued in its own name. It is actually able to own property in its own name. It's not the same case with a sole business. If property is acquired by you as the sole owner of the business, it simply means that the property will be registered in your name. And of course, if the business is to be sued, they'll sue the business in you as the sole owner of the business. So you don't have the capacity, the capacity to contract in this case, it will likely be in your name as the sole owner of the sole proprietorship form of business. So that's how basically you simply get your differences. You get your difference. So I've told you the secrets. You just know the characteristics. Just look at how that particular kiosk of yours, kiosk in your neighborhood, how it actually operates. List down the characteristics. It was formed by a sole person. He's the one running the businesses. There are actually few legal formalities in the formation of this kind of form of business. Then you compare with the other side of the company. In another way, they normally actually test and ask, what are the advantages of one over the other? So if they ask for the advantages of one over the other, the same case, know the characteristics. You'll be able to get the advantages of one over the other. Like, for example, in this case, if you look at this particular characteristic, easy to keep business secrets. That is an advantage that a sole proprietorship has over a company. So what are the advantages of a sole business over a company? So you can be able to get them from the characteristics, So I want us to look at partnership. Partnership partnership. So you can now look at partnership. Partnership. Of course, if you look at the notes I've sent, they have gone into details to give those distinctions by listing them like that. But that's the shortcut to know the differences. But if you look at your notes that I've just sent in the group, you'll see they have gone into details. A sole proprietorship form of business actually operates like this, and a company operates like this. So you can, if you want deeper details, you can go to those notes, you'll be able to see them. But if you are doing short notes, you can write what I've just written, and of course, remember what I've just taught right now. Then partnership, what are the characteristics of a partnership form of a business? So number one, what you need to be able to note about partnership forms of business. Number one, they are regulated by the Partnership Act. They are regulated. They are regulated by the Partnership Act. They are regulated by the Partnership Act. By the Partnership Act. Another thing about them is that they are formed by 2 up to 20 persons. That is for a normal partnership. And in case it is a banking partnership, for banking businesses, for banking and insurance businesses, banking and insurance businesses, they are formed by 1 up to 10 persons. They are formed by 1 up to 10 persons. They are formed by 1 up to 10 persons. Another thing about them that you need to be able to know as a characteristic, capital is contributed by the partners. Capital is contributed by the partners. Capital is contributed by the partners. Capital is normally contributed by the partners. Another thing to note about them, profits are shared. Profits are shared among the partners. Profits are shared among the partners in an agreed ratio. Profits are shared among the partners in an agreed ratio. Profits are shared among the partners in an agreed ratio. Then the partners share duties among themselves. The partners share duties among themselves. So they share duties amongst themselves as to how the business will actually be run. The business will actually be run. Another thing to note about them, about partnerships. Number 6. About partnerships. Number 6. You can say the tax liability is on the partners, themselves. Another thing is that there's no principle of separate legal entity. There is no principle of separate legal entity. There's no principle of separate legal entity. There's no principle of separate legal entity. So those are some of the key characteristics about a partnership, the key characteristics about a partnership form of a business, So the key characteristics about a partnership form of business. So to get the difference, you just compare with the companies. So you say, in this case, we are saying number 1, they're actually regulated by the Partnership Act. What about companies? They are regulated by the Companies Act, which I've really mentioned since we started. The companies are regulated by the Companies Act of 2015. So partnerships are usually regulated by the Partnership Act. They're usually regulated by the Partnership Act. So that is a difference you can actually be able to mention. Number 2, they are formed by 2 up to 20 persons. And for banking and insurance businesses, they're usually formed by 1 up to 10 persons. So that is a requirement. If it is an insurance or banking business, the number of maximum partners will actually be, so it is actually supposed to be 2 here, not 1, 2 up to 10 persons. It is actually a requirement that it is actually 2 up to 10 persons, 2 up to 10 persons, 2 up to 10 persons. But in the case of a company, if it is a private company, then of course you are saying the number of members can actually be one, or the number of persons to form a private company can be 1 up to 50. If it is a public company, then the minimum number of persons to form the public company is usually, 2. So that is a distinction you can actually be able to mention. For partnerships, it is 2 up to 20 persons. If it is a banking or insurance partnership, 2 up to 10. While in a company, if it is a private company, it is 1 up to 50 persons. If it is a public company, a minimum of 2 persons can be able to form the public company. And of course, there is usually no maximum limit. There's usually no maximum limit as to how many persons can be able to form a public company. They can even be 1 million. They can be 1 trillion. They can even be 2 million. So they don't give the maximum limits. They don't give the maximum limits. So that is a distinction you can actually be able to mention. So number 3, capital. Mostly you'll find that in a partnership, they'll say, in this case, they'll say, for example, Anna. They'll say, let's say, for example, Anna, how much are you going to contribute? So in this case, there's a partnership that is being formed between Anna, Sharon, and Teresia. Sharon and Teresia. So they want to set up a very big business. So they say, Anna, utatoa ngapi? Utatoa ngapi? Anna says, I'll do 500. They ask Sharon, utatoa ngapi? Sharon says, I'll do 1 million. They ask Teresia. Teresia just won a jackpot, a SportPesa jackpot. Teresia says, I'll bring 10 million. You don't have to worry. I have won a jackpot for SportPesa. So I'll bring 10 million. So they contribute together, then they actually basically set up the business. So that's how they raise their capital. What about a company? So the company basically will actually go for option of having to sell shares. They basically raise what we call share capital. They can go for the option of having to borrow. They borrow what we call and basically raise what we call debt capital. So in a company, how do they raise their capital? Wanauza shares. Wana raise kitu inaitwa share capital. Wanauza shares, watu wanalete pesa. Hiyo ndio inatumika kama capital to run the business. Ama wana borrow or basically sell what we call debentures in a company. And of course, they raise what we call debt capital. That's how they raise their capital. But now in this case, kwa hii partnership ilikuwa formed between Anna, Sharon and Teresia. Unaona, walikuwa wanachomoa ile pesa wako nayo, wanalete pamoja, wana set up the business. So that's how they raise their capital. If you compare the other side of the company, they mostly sell shares and of course, basically raise capital through what we call debt capital by basically borrowing from outside, or selling bonds. So they can sell a corporate bond. Like how the government raises capital to finance its budget, or raises funds to finance its budget by selling what we call treasury bonds. In the same case, a company can be able to sell what we call corporate bonds. Wanakuzia bond, unarusha pesa yako ndani, then unapata interest and of course the principal amount at the end of the maturity period of the bond. So that's how they raise their capital in the case of a company. But for partnership, mostly they'll basically contribute as partners as to how much they can actually be able to bring in. Profits will actually basically be shared among the partners. Maybe they'll agree according to the capital contribution ratio. So ula lilete chapa mob, ula lilete domingi, ndio atapata profit share ya juu. So they'll basically just agree as to how they'll actually be able to maybe share the profits. In the case of a company, they'll share it in form of maybe dividends according to the number of shares you have in the company. So they say basically dividends this will be paid 6 shillings per share. It simply means that if you have more shares, then basically you'll likely be able to get higher dividends. Another thing, you are saying that in a partnership, the duties are usually shared among the partners themselves. And you find that mostly in a partnership, there'll be that particular aspect of what we call specialization. So remember, in this case, Anna is actually a qualified accountant. Sharon is actually also a qualified accountant. Teresia is actually also a qualified accountant. So they come up with an accounting firm. Anna is actually very good in bookkeeping. Sharon is actually very good in auditing, while Teresia anapenda mambo ya management consultancy na mambo ya HR, kusukumana na watu. So basically they form an accounting firm. So you find that Anna basically specializes in bookkeeping. She becomes a guru in that particular area. So they are likely to specialize. So they run the business by themselves. But kwa kampuni tumesema aje, wana appoint directors. So wao wana relax tu, wanashughulika na vitu zao huko na huko. Then at the end of the financial year wanakuja kuuliza directors, how has the company performed? Kuna dividends. We need dividends. Kama mjelete dividends, tunawafuta na tuna appoint other directors to run the company. So they have that particular power as shareholders or owners of the company. But in a partnership, most probably they'll get involved in the running of the partnership business. Or maybe it could be, in this case, we have Gabriel, and of course we have Bob. So these two guys actually basically qualified doctors. So Gabriel, in this case, likes things to do with gyna. He's a gynecologist. While in this case, Bob likes things to do with children, pediatrics. So they come up with a clinic. And in that particular clinic, Bob specializes in matters to do with the children. And in this case, Gabriel specializes in matters to do with the gyna. So they'll be involved in the running of the business. And of course, they can be able to specialize and become experts or have expertise in that particular area. So that is what actually happens in a partnership form of business. But huko kampuni tunasema, you appoint directors and then you just sit back and relax at home and wait at the end of the financial year. You go to the AGM, mnaangalia dividends inalipwa ngapi, mna approve, mnalipa kama shareholders or owners of the company. Then we've said that the tax liability in a partnership is normally on the partners themselves. I think you umesoma. Kama umepitia kwa class inaitwa Public Finance and Taxation, kuna mahali mlikuwa mna calculate ama mnafanya kitu inaitwa taxation of partnerships. Basically, to realize how the partnership will likely be taxed, you used to basically calculate the profit of the partnership business itself, and of course you share the profits among the partners, then you tax them individually using the individual graduated scale. Ile kama unalipwa mshahara, how do they basically tax? So once you basically realize the profit of the partnership business, you now share it among the partners in the agreed ratio. Then after that, you tax them individually. But in the case of the company, you are taught, or basically you learned that in case of taxation of a company, they do what we call corporate tax, corporation tax at 30%. So you can see the taxation liability in a company is on the company itself, while in the case of a partnership, it is on the partners themselves. After the profit has been shared among them, they don't tax that profit of the partnership business at kwamba wanaweka hapo maybe 30%. Hapana, wana distribute kwanza hizo profits among the partners, then wanawarushia hiyo tax hapo, wanakula hiyo burden ya tax wao wenyewe. But in the case of a company, there's what we call corporate tax at 30%. Once you realize the profit of the company, basically now that's where basically you tax and remit the amount to the taxman. So you can see that is a difference. Huko kwa partnership, the tax burden is on the partners, the owners of the business. In the case of a company, the tax burden is on the company itself in form of corporate tax. So that is already a difference that you can actually be able to mention. You can actually be able to mention. There is no principle of separate legal entity. So in this case, when I mentioned that, just remember what we learned about a company. It can be able to sue or be sued in its own name, not the same case with a partnership. Wakilete kesi kwa koti, watasue hao partners kwa majina zao. Utaona wamewalist wote. They list Teresia, Sharon, and Anna versus those other parties. They list Bob, and in this case, they list Bob and Gabriel and the other persons. So suing of a partnership will likely basically be in the name of the partners, but not in the same case with the company. In the company, it will be in the name of the company because it is a separate legal entity. It is a separate legal entity. So those are some of the differences you can actually be able to mention with regards to a partnership form of business and a company, So I want us to look at the last one, cooperative societies, Cooperative societies. Cooperative societies. Cooperative societies. Cooperative societies. Cooperative societies. Number one, what you need to be able to note about them, they are regulated by the Cooperative Societies Act. 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 How do they raise their capital? They raise their capital. They raise capital. They raise capital. They raise capital through membership fee. Through membership fee. Membership fee, comma, donor funding, donor funding, donor funding. I'll explain them. Donor funding or government grants, or government grants. Another thing is that membership is usually mostly from persons of the same profession, and from a specific area, Another thing to note about them, their main objective is to serve the members. Their main objective is to serve the members, and profit making is a secondary objective. For them. It's not their main objective. Then also another thing is that their source of capital is homogeneous. I'll explain what we mean by this, so you don't have to worry. Their source of capital is homogeneous. It is uniform. It is homogeneous. Another thing to note about them. Cooperative societies. So we've said their main objective is to serve the members, and profit making is a secondary objective. Also, we've said that their source of capital is homogeneous. Another thing, they are managed by a management committee. Drawn from the members themselves. So they are usually managed by a management committee, just drawn from the members themselves. Another thing to note about them, they are sometimes involved in activities to serve in activities to serve the community at large. The community at large. The community at large. So that's what we mean by a cooperative society. So they are regulated by the Cooperative Societies Act. They raise their capital through membership fee. So when you join them, they'll tell you basically for you to become a member of our cooperative society, you have to pay, let's say, for example, 1,000 shillings as the membership fee, then you become a member. Or sometimes they can get donor funding, so they can be funded by donors to run their activities, or sometimes they can get what we call government grants. Then their membership is mostly from persons of the same profession or trade. So maybe you can find that these particular cooperative societies have been formed by, let's say, for example, tea farmers in Kericho. So they come up with their own body to be able to put there together their own resources so that they can actually basically be effective in tea farming. So because if they come together, you might find that for them, they'll actually be able to get donor funding and even set up their own factory to manufacture the tea. Because maybe they are transporting the tea very far away, which is actually very costly for them. So they simply come together, come up with a membership fee and actually push to get, let's say, for example, government funding or donor funding, and they set up their own tea processing plant there at Kericho. Then it can actually be able to manufacture that tea and they sell into different markets. And of course, in this case, they will serve the members in this case because these members of that particular cooperative society, they don't have to transport their tea very far away. So they just take it to the factory that has been set up. It is basically manufactured and they are basically paid their money from that particular factory and is actually sold somewhere else. Just in the same relation we are talking about, they basically mostly also don't just concentrate on serving the members in terms of, let's say, for example, taking up their tea. They might actually end up even setting up other facilities, let's say, for example, institutions like a health facility, because they might realize that maybe people are not actually able to access healthcare services in that particular area because the hospital is actually very far. So they could actually end up also setting up, let's say, for example, a health facility so that it can actually serve the members in that particular community. So to serve the members of the cooperative society and also other members of the society. So in this case, sometimes they're involved in activities to serve the community at large, but not actually only just to serve the members. So they can set up maybe education facilities, let's say, for example, a school to serve them. But that's why in most instances, you find that the government actually encourages the cooperative movement because it basically leads to what we call developments in the society. So that's why they'll basically be, the government will actually be very friendly to them. And you'll basically also realize that, for example, their tax rates are usually actually a bit lower compared to a company. So maybe you are told it is normally, is it 27.5% compared to that of a company, which is actually at 30%. So their tax rates are usually actually basically favorable, a bit favorable compared to companies. So another thing you are saying that it is mostly by members of the same profession. It does, as I've said, tea farmers, or maybe coffee farmers in Muranga, or maybe dairy farmers in, let's say, for example, Nyeri. So they set up a cooperative society, which will basically set up, let's say, for example, a milk processing plant in Nyeri. Then from there, the milk is actually sold to other markets. And of course, they are paid their money from the cooperative society. Membership is mostly actually drawn from a very specific area. So in this case, we are saying that, for example, if it is actually maybe tea farmers in Kericho, you'll find that most of the members of that particular cooperative society will come from Kericho. If it is basically dairy farmers, they'll mostly come from Nyeri as a county. Not like, let's say, for example, not like the whole country. So that is actually also what you need to be able to note about them. Their main objective is actually to serve the members. So profit making for them is usually just a secondary objective. So they'll first of all basically focus on serving the members, ensuring that the members of that cooperative society are benefiting from the main reason or the main purpose or the main objective as to why the cooperative society was actually formed. Then their capital is actually homogeneous. It is uniform in nature. So that's connected to the point that when you join them, they ask you to pay a membership fee of 1,000 shillings. Kama ni 1,000, mtakuwa mnalipa 1,000 wote kama membership. It is actually homogeneous. It is actually very uniform. It is actually very uniform. So they are usually managed by a management committee that is normally drawn from the members themselves. Let's say, for example, if there are 1,000 members, they'll choose amongst them like 20 members to be able to manage or run the activities of that particular cooperative society. So management is actually usually drawn from the members themselves through an appointment by the members themselves. So those are some of the key characteristics of a cooperative society, So in this case, you know the drill. In this case, you know the drill. You look at the characteristic and of course compare with the company, you'll get a difference. You know the drill. In this case, you know the drill. The drill is, in this case, let's say, for example, regulated by the cooperative societies. Companies are regulated by the Companies Act. Number two, there is capital through membership fee, donor funding, and government grants. How does a company raise capital? Sale of shares through share capital, or sale of debentures through what we call debt capital. That is a difference. Membership is usually of persons of the same profession and drawn from a very specific area. In a company, membership can actually be drawn from a very wide area. A shareholder at Safaricom might come from Busia, might come from Malindi, might come from Lamu, might come from Kitui, might come from, let's say, for example, Muranga, might come from Embu, might come from Garissa. So membership mostly for companies might be drawn from a very wide area compared to a cooperative society, which is actually basically from a specific area like a county. That is a difference. Their main objective is actually to serve the members. Profit making for them is actually a secondary objective. What about a company? Kampuni lazima profits zikuwe ndo at the end of the financial year enjoy dividends. So the main objective of a company is to make profits for the shareholders or the owners of the company. But for this one, they first of all concentrate in ensuring the main purpose as to why they form is actually basically to serve the members. They are managed by a management committee that is normally drawn from the members themselves. This is actually quite disadvantageous because sometimes they suffer from what we call lack of management expertise. So these members, maybe they have not actually basically learned about how to manage businesses or basically how to manage people. So they are probably likely going to suffer from what we call lack of management expertise. Now here, you might find that since they are drawn from a very specific area, they know each other as members. So kuna kutakuwa na mshene mingi. Ule haezi kuwa chairman, ule haezi kuwa secretary, ule hata wacha tu. So kuna mshene inatembea. So sometimes kuna vitina mingi tu. So you can't compare it with a company whereby you only meet as members in an annual general meeting. So I hope you understand what I mean. Kuna issues to management unapata haiko run properly. Wanasema chairman sijui ameiba pesa, tutamtoa, huyu tutamtoa. People come to the office, they make a lot of noise, so a lot of confusion. So sometimes they suffer from what we call lack of management expertise. But in the case of a company, tumesema nini? Una appoint expertise, directors, unawaita, unawapigisha interview, ama mnasema huyu ako qualified. He has been a director in another company and the company was actually very successful. So you engage experts to run the company in the case of a company. But here, unapata mshene imetumaliza ama this management committee, since ijaenda kusomea mambo ya management, they suffer from what we call lack of management expertise. So those are some of the differences between a cooperative society and of course, the other side, you know the drill, the other side of a company, So that is the distinction between a company and the other forms of business, So for today, we are going to end there. Then of course, next time we'll wind up with this particular topic and start the topic of formation of companies, formation of companies. So unless there's a question, you can actually ask at this particular point. But of course, I would wish to end the class there. I've already shared the notes, topic 1 up to topic 4. What is remaining for me is to share the past paper questions. Which I'll actually be able to share, maybe after this particular class, I'd share a link that actually contains all the past paper questions, which we'll be looking at as we go on with the syllabus. So probably after the first topic, we'll start now looking at questions as we go on, like that. So unless there's a question, you can ask at this particular point. You can unmute yourself, or basically you can pause it in the chat so that we can be able to answer like in the next 2 or 3 minutes. Is there a question, Anna? I can see Anna Kio. Anna Kio, do you have a question? Anna Kio, do you have a question? Yes?
No, I'm good.
You are good, eh?
Yeah.
What about Caroline?
I'm also good.
You are good, eh? What about Bob?
Bob is good. I lost my connection.
You lost your connection?
Yeah, I lost my connection when we were talking of the characteristic number 7 of the cooperative societies, but I'm now back.
You're now back, huh?
Yeah.
But I think it's okay. Probably we'll share. I've recorded the video. Probably we'll share maybe the link later on.
Yeah.
Julius is asking, what is the veil of incorporation? That is basically what we'll wind up with in our next class before we start the topic of formation. So I'll teach you about the veil of incorporation. I'll teach you about the veil of incorporation. You'll be able to understand it. That is basically what we'll wind up with in our next session. Then we start the next topic. The next topic.
So where are we now? I disconnected when we were talking of the 7th characteristics.
We just basically after I mentioned that particular characteristic number 7, we've just basically discussed the distinctions between a cooperative society and a company. We just discussed the distinctions between a cooperative society and a company after that. Okay. So we'll see if it's possible. We'll be able to share the link for this particular video for those who have actually maybe had connection issues, so that you can be able to maybe follow up to the last bit.
Yeah, that should be good.
So I think you guys can have a good night. We'll meet next time. So that is actually on Sunday from 2 p.m. Sunday from 2 p.m.